We just helped an exporter to save rupees 10 crores by enabling them claim cash refund from Government of India. Wanted to know how? Government of India gives many incentives for exporters. The funny part is, most exporters don't even know. Even if they know, they don't even fully claim them. If you are an exporter or tax or finance head of a company, hit that bell icon and subscribe to our channel. I'll help you understand 7 export incentive you can start using right after watching this video. Number 1, RoDTEP scheme on exported products. RoDTEP meaning remission of duties and taxes on export products. The objective of this scheme is to compensate the exporters for those taxes on which they don't get either refund or input tax credit. Every exporter must be paying taxes on their fuel, electricity, stamp duty, toll tax, for which they neither get input tax credit nor get refund from the government, whether it is state or central government. The RoDTEP scheme intend to compensate the exporter for these taxes. This benefit is given as an e-Scrip or a certificate, which usually is calculated as a percentage of the export ranging from 2 to 5%. Next time when you export your goods and file shipping bill, ensure to check that box which allows you to claim RoDTEP scrips. Once you do it, this will get credited to your customs account immediately. You either use it or sell it in the open market for cash. Number 2, the Advance Authorisation scheme. This scheme allows you to import raw material without paying customs duty and IGST, provided you use it for manufacture of finished goods and export them within 18 months from the date you have imported the raw material. The key condition is that the minimum value addition should be 15%, meaning thereby you are importing raw material worth 10 lakhs, your finished goods value must be at least 15% more than it, that is at least 11,50,000. You have to do this export within 18 months. Therefore, you have sufficient time to do this. Number 3, EPCG scheme, which means Export Promotion of Capital Goods. This scheme allows you to import capital goods which are required for manufacturing your finished goods or providing your output services or providing your export of services. The key condition is that the export value of your goods or services should be 6 times the customs duty you have saved under this scheme. To illustrate, you have imported capital goods or machinery worth 10 crores on which you are supposed to pay say 30% of it as customs duty, which is 3 crores, then you should export at least 18 crores, which is 3 into 6 of the customs duty saved, 18 crores as export. It may be export of goods or it may be export of services. But you have to declare upfront whether you are doing export of goods or export of services and stick to it. This 18 crores exports you will have to do within 6 years. Number 4, the interest equalization levy. If you are an exporter of goods, you must be paying a lot of interest to your bankers, either in connection with procuring your raw materials or waiting for your customer to pay after exporting. If you are one of such exporter, the government will help you reduce that interest cost up to 3% under this interest equalization scheme. To illustrate, say you have availed 5 crores of loan from your bank to purchase your raw materials, manufacture them and sell to your export to your customer, and then your customer will pay you after 60 days. However, you will have to pay interest right from the day you have purchased the raw material till the customer pays you. This interest percentage may be ranging from 11% to 15%, or it may go up to 20% as well. The Government of India will help you to reduce this interest cost at least up to 3% under this interest equalization scheme. Number 5, GST refund. If you are an exporter of goods, you might have paid GST on your input services, capital goods. which you have utilized for manufacturing your finished goods, which you have ultimately exported to your customer. Since you are into export, you might not be in a position to utilize your input tax credit of the GST paid on your procurements. The government allows you to claim refund of such ITC because you will not be in a position to utilize such ITC being an exporter. Number 6, the duty drawback scheme. This scheme allows you to claim refund of customs duty which went into the finished goods which you have exported. To illustrate, say you have manufactured a mobile phone and exported outside the country. All the components which are required to manufacture that mobile phone might not be available in India. Therefore, you will invariably end up importing them from other countries and pay customs duty. Under this scheme, the customs duty, whatever you have paid on that imported components, will get refunded upon export. Whenever you export next time and file the shipping bill, check that box to claim duty drawback so that it will refund you the customs duty component involved in the finished goods, and this money will hit your bank account within 30 to 45 days without any follow-up with the customs authorities. Number 7, and the most important thing, the free trade agreements. In the last 2 years, India has entered into free trade agreements with many countries ranging from UAE, UK, EU, Australia, and many other countries. FTAs are in progress. Basically, FTA give you two benefits. If you import goods from a FTA partner country, say UK, you can import them either without paying customs duty or at a lower customs duty rate. As against that, if you import the same goods from a country with whom we don't have a FTA, you will have to pay the normal customs duty. Therefore, by using FTA, you will be saving lot of customs duty. The other benefit FTA gives is when you export goods to a country with whom we have an FTA, the customer in such country can import these goods without paying customs duty or at a concessional rate. To illustrate, a customer is exploring to import a mobile phone from India, and a customer is exploring to import a mobile phone from two suppliers. One supplier is in India, another supplier is, say, in Bangladesh. Recently, we have concluded an FTA with EU. If the customer who is sitting in EU, if he is exploring these two suppliers, one is in Bangladesh and another is in India, if everything else is same, if the pricing is same, they will tend to choose the supplier in India only because we have an FTA with them, meaning thereby the customer can import by paying lesser customs duty or no customs duty. Since there is no FTA between EU and Bangladesh, the supplier who is in Bangladesh is at a disadvantageous position. If you want to claim this FTA benefit when you are exporting, the only thing what you have to do is get a certificate of origin. The only thing what you should do when you are exporting goods to a foreign country and the customer wants to claim FTA benefit, you have to get a certificate of origin from DGFT and give it to your customer so that they can claim the benefit. Are you an exporter or importer and not using any of these schemes? Then you are leaving significant money on table. Just go and fix it. If you find this video helpful, subscribe to our channel and hit that bell icon. See you in my next video.